Richard Jeanneret, America's Vice Chair of Transaction Advisory Services, Ernst & Young. Richard, thanks for sitting down with me.
Happy to be here.
We'll talk a little bit about transactions and deal making, and the environment. People have tossed around the term volatility. People have tossed around the term uncertainty, but yet there's a lot of deals being made right now. Right. What's driving all the deals that are being made?
Well, I think there is a tremendous desire by companies to grow, and organic growth is tougher, and so companies are looking to grow in inorganic ways. Across borders in their own developed markets. But M&A deal making is not as robust as it was the last few years. And so you're seeing some headline poppers, but when you look at pure volumes, they're actually down year over year. And this has occurred for 5 years in a row now. And so the fundamentals for M&A are very strong. Record amounts of cash on corporate balance sheets, hundreds of billions of dry powder in private equity, reasonably decent credit markets to get deal financing. But there is some concern about the uncertainty in the global economy, so that's undermining confidence to a degree and restraining deal activity. And the confidence is a multifaceted dynamic impacted by geopolitical issues, economic issues, regulation, tax policy, from time to time natural events like earthquakes and tsunamis, and political unrest as well. And so we've had a lot of that in the last year, and the global economy and its recovery have been slowing. It's a bit more fragile than it's ever been, and so it's much more susceptible to uncertainty, and there's certainly been plenty of it. At the end of the day, the companies that are doing deals that are being bold, they're having the courage, they see the fundamentals today being strong, they feel like this is a good buying opportunity, and so they're doing deals. I think those companies that do those deals are going to be winners when they look back in a few years and be happy about what they've done.
Do you think it's those management teams and those entrepreneurs that have more of a tolerance for risk and look at that uncertainty, as you said, as a time in saying that it's a good time to buy?
Yeah.
It's a company with very solid fundamentals. It's a company that has a very solid marketplace, a developed product, a mature company. And in those instances, those deals are the ones that are being made? Is that really what you're saying?
We just completed our Global Capital Confidence Barometer, something we do twice a year. We surveyed 1,000 C-suite executives around the globe on M&A, capital flows, and their views on the economy and related things. And what's interesting is there's a greater desire today than there was 6 months ago, when arguably the economy was predicted to be in better shape. There was maybe a little less volatility. And despite all of that, I think there's greater uncertainty today than there was back in the late winter, early spring. Yet more optimism around doing deals, because that's a way to get at growth. I think what we've seen is companies are better prepared to do deals today than they have at any point in time in the last 3 or 4 years. It's a function of getting their balance sheets in good order, paring the unnecessary costs in their business. Management teams being as focused as they've ever been, and boards willing to support aggressive activity for game-changing kinds of deals. So I think you're right. I think there's an appetite to take smart risk. Companies better understand how to underwrite value and minimize risk today than they did 4 or 5 years ago. The recession and the financial crisis taught them a lot about their previous deal making that opened their eyes. And so the way they do deals today is different than how they did them before. The way they underwrite value is different today than what they did before, and the way they minimize risk. So I think is different today than what they did before. So I think they're smarter about assessing value, smarter about minimizing risk, and they've got the boardroom behind them to do deals. So it's a matter of having the courage to be bold and take advantage of the opportunity in the market today, which we think is there.
The folks that are doing that, what do you see as a trait that those people have? Beyond the appetite for risk, but the ability to get that board behind them, the ability to get the team behind them, the ability to go out there and really consummate that deal with a lot of backing that's different from the folks that want to do deals that aren't capable of doing that.
Well, I would say the single biggest issue is those who want to do deals for the sake of the deal, and those who want to do deals to help transform their companies, to grow, to create shareholder value, to think for the long term. And there are lots of guys out there that are deal junkies that love doing deals, but are they doing them for the right reasons, and are they doing them with the shareholder in mind? The ultimate game here is shareholder value. Whether it's a public company, a private company, private equity-backed investors, it's all about creating value. and it's creating value in the long term. And I think that's the difference between today and yesteryear, and what distinguishes those people that do very good deals. It's not just to do the deal. It's to do the deal to help transform the company to create more value for its shareholders.
You know, you mentioned the term deal junkie, and I've heard it several times, that it's one thing to buy a company, but that doesn't do anything. And I think that Michael Dell made that comment yesterday, was that buying a company doesn't create any value. It's the successful ability to integrate that organization, to grow it.
Right.
How do you work with clients, and what do you see of those who are very successful in it that really makes them different from everyone else?
Well, we agree with that, by the way. We think that value is won or lost after the deal is done. Clearly, there's a value element prior to a transaction, but the ability to enhance value or to minimize risk in a transaction occurs after the deal is done. And there's a variety of different ways to get at it. It's companies that think about integration as a key element of the deal before the deal. It is a risk of the deal. They underwrite that risk as part of the transaction. They prepare for that part of the process during both prior to, during, and at the closing. They go at it very aggressively afterwards with 100-day plans, with 6-month plans, with 9, 12. All depends on how long the deal will take to integrate, depending on its dynamics. But those organizations that plan for that view that as a value driver, as well as something that creates risk, generally do the best with it. And they realize that they may not always know how to do it. I think some of the best companies at integration have learned from mistakes in the past, and they realize they don't always have the right skills to do something like that. So they go and they get it from the outside. They bring in advisors to help them think through it. The ones that do it the best start very early on. They develop it strategically and don't look at it as just an operational issue. It's both strategic and operational.
It's almost akin to what what Tom Adams was talking about yesterday, I guess 2 days ago now, when he was talking about on the IPO panel, that they really started thinking about 6 months before they were ready to start. The preparation really became that key. You talk about that concept of being risk averse. I mean, risk tolerant. Do you think that the ability to, or companies that have the ability to create a culture where failure is encouraged and tolerated, that those companies, when they go on the acquisitions, not organically but inorganically begin to acquire, seem to do better over time? Have you done any studies on that?
We haven't done any studies, but that intuitively makes sense to me. I mean, you have to have the right balance there, and you have to have history of success. But if you're afraid to fail, you'll never get anything done. Those companies that take the right amount of risk generally win in the long term. But using advisors like ourselves, you can minimize the risk, and you can actually find hidden value. Very often, what we get asked to do for a client is to help them mitigate their risk, but what we try to do is actually help them find value in a transaction that they haven't seen. And that's a big part of how we serve our clients, both before the deal, during the deal, and after they've gotten the deal done. And I think those companies that are open-minded to that realize they don't know everything, that the crisis of 2008 taught them things that they hadn't perhaps realized before. We learned a lot in 2008 and 2009 about deals that got done prior to the crisis, that the things that caused a deal either to be very successful or to fail were not things that were very well evaluated during the acquisition and underwriting process.
Interesting. Obviously, with confidentiality, you might not be able to talk about specific examples with names. Can you give me an example of how value could be found?
Well, you talked about integration. There's often huge value in integration that is either not considered in a transaction or not underwritten to the degree it could be. It could be cost synergy, but more importantly, one of the things we find that's not always evaluated to its extreme is market synergy. How does buying a new asset, a new product, getting into a new geography, create market synergies in other parts of the company or into new markets that a company's never been in before? And that's the kind of hidden value that we can help our clients unlock and hopefully make our role much more strategic to them.
I was having a conversation earlier. I mentioned him, Tom Pearson. 3 seemingly unrelated business segments. but yet found those operational efficiencies in terms of that. Are you finding today that companies are looking at that type of model as well, instead of saying that, here's our middle piece and here's the spokes around it, and these are complementary companies, but potentially there are companies that at the surface don't look like they match well, but they do create those operational efficiencies across different lines. Are you finding people starting to go that direction?
We are, and we're also finding companies, because of certain core competencies that they have, actually creating new businesses within businesses.
Yes.
I was meeting with a CEO earlier today, and he has a consumer goods company, and one of the things that they were looking at was, how do you package our product more efficiently, more environmentally friendly, and at a lower cost? And they decided that was ultimately important to their brand, to their strategy, to their top line. And they set about coming up with a more efficient, effective, lower cost, and more environmentally friendly way to do it. And what they created was not only a solution for their own business, but they actually produced a new product that they are now selling, a packaging solution to other consumer goods companies. So what started as something that was important to the CEO, a core value to the company, as a way to make the company more competitive, actually became a new product for them.
Interesting. Have you found, and maybe this is, there is no difference, but the difference between those entrepreneurs and their ability to approach deals versus potentially professional managers, people who are very P&L focused and operationally focused, have you seen any differences between those two groups?
You mean in terms of how they do deals?
How they approach deals.
I see a big, entrepreneurs just think differently. They're fundamentally more creative. They see risk differently than the professional manager. They see value differently than the professional manager. And so they are just as knowledgeable about deal making, how you underwrite, cash flow and what multiple to put on them to value an organization. But what I think what the entrepreneur sees is value and risk very differently. And I think the creative spirit that you find in an entrepreneur looks at a deal very differently. He might see a lot more value than a professional manager who's thinking more structurally and functionally about doing a deal, and perhaps sees risk. Sometimes entrepreneurs don't see risk as well as professionals. Sometimes they take too much risk. But fundamentally, an entrepreneur is in the business of taking risk, and those that are successful, that risk pays off for them.
Fantastic. Richard, thank you very much.
My pleasure. Thank you.
Excellent.